Hey guys, it looks like China and US just can't get it together. The tariff war continues, stocks are trading near the 200-day moving average, and the question is, how do you hedge your portfolio without going short or setting up dangerous stop losses? I'm going to show you today how you can have your cake and eat it too. Hey guys, we're back in the lab, and today I'm going to show you the relationship between bonds and stocks and explain to you how you can use bonds as a hedge in your portfolio. Right here, you're looking at the S&P 500. Notice it's been going up most of 2018. And notice bonds are coming down. That's fairly typical. It's not unusual for bonds to go down when stocks go up. But look at what happens over here when stocks are trading below the 200-day moving average. That's this blue line here. That's the 200-day moving average. When stocks begin trading below the 200-day moving average, as you could see right here, this is when the China tariff issue started really heating up. Bonds started moving up. So as soon as the stock market gets in trouble or starts trading below the 200-day moving average, bonds go up. Now, I know some of you are going to say, well, interest rates are heading higher. That means bonds are heading lower. Yes, it does mean bonds are heading lower. That's what we're seeing here. But anytime the stock market gets in trouble, the Fed tends to push back rate hikes. And we saw that during the minutes a few weeks ago. The Fed minutes came out and the Fed said we're going to push back rate hikes if economy doesn't sustain itself. And that's what we're seeing right now. So whenever the S&P 500 gets into trouble, bonds rally. So the question is, how do you take advantage of that? This is a position cluster. This position cluster was initiated on the 16th and closed out on the 3rd of December. So it was opened on November 16th, closed out December 3rd. It was held for 2 weeks. It's called a cluster because we initiate several different stocks. We initiate 3 stocks and we put a little bit of a bond position. This is a triple-digit ETF, bond ETF. And notice we only had about 10% of the account in the bond ETF. The rest of the 90% was in equities. And look at what happened. The bonds gave us an extra $12,000. Overall, the cluster lost about $44,000, but this part of the cluster made about $60,000. So the cluster actually made money even though 2 positions out of the cluster lost money. And that's partly because of the bond. The bond helped us gain about $12,000, which helped us substantially overcome this loss. So keep in mind, whenever you're trading the stock market, bonds offer a very good protection, and it's not a stop loss, and it's not an inverse position that goes against you and locks in your loss. And if you enjoyed this tutorial, I created a special 2-hour class. It talks about profit clusters, relative strength, and hedging with bonds, which is what we talked about today. Please follow the link below this video to check it out right away. Talk soon.